Well, as oil prices retreat and AI spending evolves, investors are asking whether market leadership is finally broadening beyond the Mag 7. Joining us to I meant to ask, is it Yonka or Jonka?
Yonka.
Yeah, I thought so, sorry.
As if it's a Y, yeah.
3, 2, 1. Well, as oil prices retreat and AI spending evolves, investors are asking whether market leadership is finally broadening beyond the Mag 7. Joining us to discuss whether next winners could emerge is Elfreda Yonka from Alfinity Investment Management. Good to see you, Elfreda.
Good morning, nice to see you.
So, a big sell-off overnight in these chip stocks, and that followed that circuit breaker in South Korea. Starting to see some bubbles maybe in this trade.
Well, I think the market is a little bit on edge at the moment, just given the extent of the gains that we have seen, particularly year to date, and the broadening of that AI ecosystem and the AI trade. For us, we take a longer term outlook on these things, and we look for companies that's in an earnings upgrade cycle. So for us, if we look across the AI big names, including the MAGs, they are actually still seeing really, really strong earnings growth and positive earnings revisions, which is what we look for. I think the important thing there is just really to balance it out. So we have of late been reducing a bit of our Mag 7 exposure in favor of some of the other names that sits in different parts, such as memory. We've bought Micron a while ago. On the networking side, we've got Broadcom, and then of course you also have the GPU, CPU balance that's also seen us adding companies like an AMD. But the important thing, I think, is just to keep that exposure to the AI trade intact and just change where you see more opportunities.
Yeah.
Because I think that is important to balance AI with non-AI as well.
So I guess ahead of Micron's earnings, and given what happened overnight with Micron shares, that might be looking quite positive there in terms of a potential buy.
Yes, definitely. I think for us, Micron, it's one of the 3 biggest memory players in the world, and it's now sitting in the top 10 on a market cap as well in the US. So it really has become a name after the last 700% run that you can't ignore from a portfolio construction point of view. Now, the reason why we've bought Micron a while ago was really because memory, which is generally quite a cyclical part of the market, is actually now in a bit of a structural upturn, we think, and that's underpinned by just a massive demand for memory in the AI build out. So the 3 biggest players just have that much capacity, and they are adding as much supply as they can, but at this point in time there's just not enough for the demand. So they are really enjoying huge price increases. And I think Micron, we all talk about AI and the tech stocks being long duration, so more expensive. So if the rates go up, like last night, you see that sell-off. Micron is still trading below a 10 times PE. So it doesn't have that huge valuation under, sort of headwind behind it as well. So we do think that today we will wait and see what they say, but we do expect to see another strong result. And for us, it really is more about the outlook and what they are seeing as far as demand is concerned. What we've heard from the other big players like SK Hynix is that they expect to see the demand-supply dynamics stay in their favor up to at least the end of 2027. So we would look to see what Micron has to say about that.
So you touched there as well about the CPU versus the GPU race. Tell us why this is happening and then where you see opportunity here.
Yes, I think the key difference between GPU and CPU is that GPU can do a lot of small tasks at the same time. So think of it as sort of the generalist in a factory and the huge amount of workers doing the same thing at the same time. That's very useful when you are training your AI models, and that is where someone like Nvidia has been the favorite of all the GPU providers, because they have been at the forefront with the biggest capacity, but also just the highest quality ones. And then they also have CUDA, the software integrated portion. So they're not just GPUs, but they have been the favorite. What has happened this year in particular is that we have gone from just that training of AI into companies actually incorporating AI in their businesses, and that's what we call inference. So you would think about it as AI just doing its job, and that is where it needs CPUs. It can't do as many jobs at the same time as a GPU, but it can do a lot of jobs at a really strong pace. And that is where I think inference really needs CPUs rather than GPUs. And the big players there would be someone like an AMD, for example, is really doing CPUs. Nvidia does it as well. And then, of course, you also are seeing a lot of the hyperscalers that's also moving and trying to create their own chips, like a Google is doing their custom chips. Broadcom is also in there, also helping with custom. So we are moving away from just the training side of the AI stage to the actual usage. And that is where I think there's also been a bottleneck because of this uptake being so strong, and particularly agentic AI requiring a huge amount of CPUs. We still have that demand-supply balance. So it is important, though, that you balance it across those and you do have a bottom-up fundamental view, and we've specifically focused on those positive earnings revisions. So for us, yes, it is the broader theme, but we pick these stocks bottom-up, earnings growth, earnings revisions focus.
What about the anti-AI trade? I mean, you can't use AI to lose weight, at least not yet. I know you're looking at some of the GLP-1 drugs.
Yes. So I think a night like last night, where you have a massive sell-off across the whole AI ecosystem, I think it is important for investors to balance their portfolios. As I've mentioned, yes, we do have a lot of exposure there, but we also have broadened out across some of the anti-AI trades. That would be sectors such as industrials, heavy equipment, pricing power, REITs, healthcare. These are sort of more anti-AI trades, and I think the balance is really good. So yes, as you've mentioned, the weight loss portion, that is where we still have Eli Lilly. We think there's definitely still a huge amount to go.
So you prefer them to Novo?
Yes, we currently prefer them to Novo. We have had Novo in the past, but recently we've switched it into Eli Lilly. They really are at the forefront of not just the type of products that they are rolling out, but they now have a pill version, so you don't have to inject yourself anymore, and the uptake there has been really good. But I think the broader theme behind that is just that they have been increasing their capacity. They have quite a few new products that's lined up that we should hear about. And then, of course, they've got the biggest market share in the US, which is the GLP-1 biggest market. And that's where we've only seen probably around 6 to 8% penetration in that market so far. So the opportunities are huge. The important thing is just to look at what multiple do you pay for this company, because it has traded expensive in the past, and that's why we've sold it. But we've recently taken that opportunity to add on as well. So that's a good anti-AI trade, for example. And then there's also companies that sits in real estate. So Welltower is one that we really like there. It's the largest senior housing company in the US. Very interesting in how they are changing the underlying business model away from doing medical services as well, and really just focusing on senior housing and continuing to buy up some of these old age homes and expanding their footprint. And that, once again, we know there's always a shortage of these high quality senior housing. So they have huge pricing power. So we're looking for stocks like that that can continue to benefit from hard assets, pricing power that's not dependent on AI.
Let's talk about the big macro picture then, and as we continue to monitor what's happening with the Strait of Hormuz. How can lagging sectors maybe perform here?
Yes, I think if you take a step back, the only thing that's really been working this year up to now with that closure has been stocks in the AI ecosystem as well as energy. What we're starting to see now is, yes, the market is starting to reduce the expectation of inflation. You're starting to see markets repricing and not expecting, that sort of interest rate cuts necessarily coming through, because this is not going to be a short-term fix. There's a lot of damage that's been done to infrastructure and so forth. So I think broadening out is really positive for the market, and particularly if you have a view that there will be less of a headwind, positive for global growth. We want to invest in cyclical stocks that can benefit in that environment. And for us, financials is still one of those sectors that there's definitely still a lot of benefit coming through from better growth, but also increased volatility, trading. So that's where we have names like a JP Morgan, for example, really high quality bank that's benefiting not just from the underlying retail bank side, but also from the stockbroking side, where they're doing a lot of M&A deals, they're really benefiting from trading, and then in addition also have that wealth arm. So it's high quality, but we're also expanding that across other regions. And I think that's the point I would make as well, is it's very important not just to be in the US. Look at other markets such as Japan, such as Europe. We've got CaixaBank, for example. We've got Mitsubishi Financial in Japan. These are all really large retail banks in their respective markets that's benefiting from this environment. So that's...
What are you liking in Australia?
Well, I think at this point in time, our Australian teams, we've got two teams at Alphinity. So the global team is obviously sitting there looking at all the AI stuff. In Australia, we have been, over the last few months, we've actually been reducing a bit of our very cyclical exposure. So we've actually cut back a bit from what we've had a really big overweight in commodities. We've reduced that somewhat, and we started to increase a bit in some of the more defensive sides of the market. So we've added to telcos, we've added to insurance, we've added to consumer staples. But underneath that, there are a few very interesting companies that we actually have bought as well that we really like. One, for example, is Codan. It sits in the tech space, but it does quite a few interesting things. So, for example, on the one hand, it is anti-defense because it's helping with monitoring and finding landmines, for example. And on the other hand, it's helping with communication for drones. And that's been really beneficial in this whole defense trade. So any company, if you take a step back, that's really benefiting from some of these broader themes, such as defense spending, that's still continuing despite the opening of the Strait of Hormuz. We like to be in those sort of themes that we know there are a lot of bottom-up exposure. But yes, we continue to like the banks, but we have cut them back as well. Consumer, we are very underweight consumer. We do think that the Australian consumer has been relatively resilient and there's no credit concerns, but we are definitely seeing them being very selective and specifically also looking for those bargains. So where we have added are those companies that's exposed more to the lower end consumer, so such as Wesfarmers, Kmart, doing really well. Superloop in the telco space is a little bit more on that lower end. So we are being very selective in those exposures and really just trying to find a highly diversified portfolio of underlying earnings leaders. So each one of these stocks that we have across the sectors have their own earnings growth story, and that's what we continue to look for in this environment.